Hello, and welcome to BeLoanReady. What are closing costs? Welcome back, writers. Let's jump right into this one. Closing costs are fees associated with the closing of a real estate transaction. You didn't think all this mortgage stuff was being done for free, did you? Did you know that on average, homebuyers will pay somewhere in the ballpark of 1 to 5% of the purchase price of their home in closing fees? To put this into perspective, if you purchased a home for $300,000, the 1% closing cost fees of this would be $3,000, and 5% puts you at $15,000. It's definitely a factor that anyone obtaining a mortgage will want to be informed about. And remember, if you are buying a home, you will most likely need money for a down payment too. See our video, Buying a Home, Cash Needed. In a refinance scenario, there are closing costs as well, but typically, they are a bit less than the costs in a home purchase. Sometimes, terms like origination fees, escrows, prepaid fees, and third-party fees get thrown around. But what does all that mean? Alright, let's have some fun with mortgage terms in regards to closing costs. Origination fees are fees charged by the mortgage lender for processing your loan application. These fees can be called things like processing fee, underwriting fee, and documentation preparation fee. Your lender may charge you a fee for the interest rate chosen, or the lender may give you a credit for an interest rate as well. Regardless, these discount points are still in the same family as origination fees. Escrow deposit. If your lender is paying taxes, insurance, and/or private mortgage insurance on your behalf, then they will establish an escrow account to accumulate your deposits to the account and pay the tax and insurance bills when they come due. They start the escrow account at the closing by collecting enough taxes and insurance to be sure there's enough in the escrow account to pay taxes when the bills come, and to avoid an escrow account shortage down the road. Prepaids. Your lender will also charge interest for a number of days depending on what day of the month your loan closes. This is done so your new loan payments can begin on the first day of a particular month. Third-party fees. The bulk of mortgage loan closing costs are fees that are being passed through from the lender to a third party. There are a lot of other parties involved in providing services for your mortgage loan application. Here are some of the more common. Credit report fee, paid to a credit bureau provider. Appraisal fee, paid to the appraiser or appraisal company that performed the appraisal. Title insurance, paid to the title company and protects the lender and the owner in situations where the title on the property is not clean. Title search fees. This is again a fee paid to the title company to ensure that there are not title issues, like unpaid taxes or liens associated with the property. Other title fees. Depending on state and property type, your lender may direct other third-party fees to be paid to the title company. These could be items like title endorsements. Survey fee. If a surveyor is required to verify the lines of your property, he or she will be paid a survey fee. Inspections. If your home requires a pest inspection, a roof inspection, well water inspection, foundation inspection, and so on, these are also third parties that will receive payment. Recording fee. This is a third-party fee that your lender will pass through to the county recorder or city recorder's office to record your new mortgage. Okay, so you understand what closing costs are and the categories of closing costs. But how do you compare all this stuff? Fortunately for you, there are laws and documentation to help with that. Ooh, more documentation. Yay, documents! A lender is required to provide you a loan estimate within 3 days of you making a mortgage application. The loan estimates set forth all the costs you'll face on the day of closing. You can check out the loan estimate form at the address seen here. The bottom line is, the loan estimate is the document for you to make an apples-to-apples comparison with other lenders' closing costs. Keep in mind that this document is an estimate, and some fees do in fact change. Because of this possibility, your lender is also required to provide you with a closing disclosure at least 3 days prior to closing so you can review it, compare it to the loan estimate, and question anything that doesn't make sense. Go ahead and check out the closing disclosure at the address seen here. Now, before we go, we should touch on refinance transactions when you hear something like no closing cost mortgage. We already stated in the beginning that this mortgage stuff isn't free, right? So how is there a no closing cost option? There isn't. All mortgages have closing costs, so be careful. The main issue is to determine who is paying for those costs, you or the lender. A lender can offer to pay a rebate to be used to pay for closing costs by offering a higher than market interest rate, which will result in a slightly higher monthly mortgage payment. So, you are trading off a higher monthly payment for lower out-of-pocket cash at closing. Another way of reducing the amount of cash to close for a refinance is to roll the closing costs into the new loan, which increases your loan amount and thus your monthly mortgage payment. another trade-off between lower cash to close versus higher monthly mortgage payment. In a purchase transaction, the seller may agree to pay for some of the buyer's closing fees, which will reduce your cash to close. So there you go. We've given you a general idea of what closing costs are, the types of closing costs, and who the fees are paid to, and a bit of knowledge so you can go crush it all day long as you shop for your next mortgage. And as always, if you have any questions, feel free to hit the help button, and a mortgage mentor will be right there to assist you. Thanks so much for watching, and I'll see you in the next video.